Hello and welcome to Valor's Top 10 for July 2025, where we talk about the top 10 stocks, why we own them, and why we're excited for these businesses over the next decade. So, obviously, Valor, we focus on safety first and safety first to create permanent wealth creation. Which is a unique focus in the investment manager world. A lot of investment managers are focusing on the last quarter, trying to keep up with the Joneses and looking at short-term performance. We're really focused on that 5, 10, 15, 20-year permanent wealth creation, which leads to us doing slightly different things, but it also has meant that it correlates with lower volatility during these difficult periods. At the moment, our largest position is actually cash, and that is not a bet that anything we know is going to happen in the world economy. It's simply the fact that we've sold some businesses over the last 12 months, and we're yet to find replacing assets for those businesses, which we think are going to return significantly more than cash. So cash is temporarily our largest investment. Ideally, we'd have no cash for our growth portfolio. It's just that we're looking, we just can't fill the portfolio with wonderful investments at reasonable prices right now. Alphabet is our second largest position. It is a much smaller position than it was a year ago. A year ago, we've reduced the position from, it was 18% at one point in time down to now about 9% position. And most of that is because there are some question marks over how quickly search will be competed away. We are very, very cognizant of the fact that AI is a very real trend. However, the fact that search is, yes, it is approximately 47% of the business now, but we see that as a relatively slow decline. But we do think it will decline over the next 5 years. But the other businesses we think will outweigh that decline, and certainly the cloud computing growth and the actual AI services of Google and Gemini being the best large language model at the moment. We think that that's very positive for Google. So we think that revenues and earnings will grow over the next decade, despite the decline in search. They've got 8 separate businesses which got over 1 billion users, and one of them is obviously search. So the other 7 businesses which have over 1 billion users, we're very confident those are wonderful businesses, and we do want to own those companies over the next 10 years. If we see search declining at a faster rate than we're comfortable with, we may reduce our position. However, we may actually see that as Alphabet integrates AI into its existing platforms and businesses, it may actually be a better scenario than many predicting, purely because that AI is going to make a lot of these companies a lot more efficient, and efficiency will mean high profit margins, and that will benefit a lot of these companies. So our third biggest investment is Constellation Software. Constellation Software is a wonderful company, and we've owned it for a few years now and done very well. We certainly think it's going to slow down. It is slowing down, but we're comfortable it's going to grow at likely double digits for the next decade, and it's not expensive if it can achieve that. At a $100 billion company, it's no longer a small company trying to buy lots of small software companies. It is a large business, so they do need the occasional large business to move the needle. However, the way that they've structured their growth, allowing not just the generals but also the sergeants and the foot soldiers to buy small software pieces right down to below $1 million in revenue, that does give them a very, very long platform for growth. And a couple of years ago, Mark Leonard said they had over 40,000 targets. It's probably a similar number today. And I do think they can keep on growing for many years to come. So we're very comfortable owning Constellation Software. It's surprisingly not that expensive, despite a strong run-up. They've done very well in their growth. Their free cash flow available to shareholders has grown solidly, and we're very comfortable this will be a wonderful business in 10 to 20 years' time. Markel has had a challenging period. However, they've used that challenge to buy back more stock. So they've increased their buybacks in the last year. The latest buyback rate was around about 3.3% per annum. Whilst their revenues and earnings have been going down, their cash flows have been quite solid. So this is still a wonderful business. We do think that whilst Ventures, the Markel Ventures business, which is their buying lots of small businesses, has slowed down in the last 12 months, we think that'll reaccelerate at some point in the next 10 to 20 years. This is somewhat counter-cyclical to the private equity boom. Their biggest competitor for these small businesses is private equity, and private credit is their biggest competitor as well in terms of the being able to purchase these things. If there are higher rates, Markel will do quite a bit better, because a lot of these other private equity companies are using debt to fund these acquisitions, whereas Markel's using cash and cash flow. So a bit of a counter-cyclical growth there in their Markel Ventures. But insurance will be fine over time. It's been a little bit weaker in the last 12 months, but over the long term, we're very comfortable Markel will be a great business. Louis Vuitton, it has had a challenging year in terms of the share price. The share price was down over 50% at one point in time. We bought after it went down nearly 40%. It kept on going down after we bought it. But the share price was down 50, I think it was 53%. On a 1% drop in sales, which we thought was a little bit excessive. We are exceptionally comfortable that Louis Vuitton will sell more of what it does and at higher prices in 10 to 20 years. And that means more Tiffany's jewelries, more Tag Heuer watches, more Louis Vuitton handbags, more Hennessy. This is a wonderful, diversified business, and we're very comfortable that across its suite of businesses, they will continue to be able to raise prices and sell more of what they're doing in 10 to 20 years' time. Certainly going through a tougher period, but that's what's gave us the opportunities to purchase at quite attractive levels. Ambev continues to grow. It's a great business. It's got net cash. They're buying back stock. They've got a very dominant position in, particularly in South America, in Brazil in terms of beer. They've got over 60% market share for beer. It's a commodities-dependent beer company, so in higher commodity prices, higher commodity currencies, and higher beer consumption in commodity countries, they will do better. At the moment, the commodity prices are not extreme, but if we get back to that 2011 level of extreme commodity prices, Amber will have very strong tailwinds, and the share price could go up materially from here. So it's a nice hedge to the Aussie dollar. But in the meantime, we're getting a 6.7% dividend yield, and we're also getting the buybacks and growth. So with net cash, we're very comfortable this is a wonderful investment at this price. ASML, they had some challenges, which is also why we're able to buy in at an attractive price. ASML producing the only world's high-end lithography machines for these high-end chips. Initially, Taiwan Semiconductor said they weren't going to use their machines, but then they caved in, and they are using them for their more complex chip manufacturing. But it's just a wonderful business. There will be more machines sold over the next couple of years, whilst growth was a little bit slower than we were expecting in the last period. We're very comfortable over the next 10 to 20 years, particularly with this AI boom. There's huge tailwinds for ASML over the next 10 years. We think there can be double-digit growth in this business over the next 10 years. And with net cash, they're buying back stock. It's a great business. Safran is one of our favourite businesses, and that continues to sort of exceed our expectations. So they're growing at 17% per annum. The engine business is doing very well, but also the other parts of the business are also doing well. Their interiors, their other aircraft parts, landing gear, nacelles, etc., are all doing really well. So the entire business is doing well. The military side of their business doing very well with increased military spend in Europe. So Safran is a wonderful business. It has virtually no debt. They've been buying back stock, and it's really well-run business, and we love aircraft engine businesses. There's only 4 aircraft engine businesses in the world, and it's been that same way for about 60 years. So we don't see that changing, and Safran is actually taking market share from Pratt & Whitney with thanks to the geared turbofan issues with Pratt & Whitney. So Safran is a great business. It's getting stronger, and we expect to continue to hold that for many years to come. Taiwan Semiconductor is shooting the lights out, 41% revenue growth in the last 12 months. They are one of the major beneficiaries of this AI boom, and we think that's going to continue, particularly with the mega cap companies, the hyperscalers, moving directly to Taiwan Semiconductor and sort of circumventing NVIDIA over the coming years. It is roughly a quarter of the price to a third of the price to build your own chips and do that in house. And we expect, and Amazon with their Trainium. So there's a lot of these big hyperscaler companies going direct to Taiwan Semiconductor. We think that NVIDIA is a great business. We just don't know what their revenues and earnings are going to look like in 5 to 10 years' time, with the hyperscalers sort of looking to circumvent those very expensive GPUs. So Taiwan Semiconductor is they make most of the world's high-end chips for this AI boom, and that's unlikely to change, purely because they've got water purification and air purification down to levels which their competitors can't compete with. So that's one of their main competitive advantages. Berkshire Hathaway, it's become a much smaller business in our portfolio in terms of the size of the what we own, because it is such a large business now. They are hitting growth constraints because it's such a large business. Still a wonderful business. We just think that their growth is going to slow from here, just because they have far fewer investments to allocate capital to. Any market correction, they'll do more than fine with share buybacks, being able to allocate capital to market correction. But they're now at a size where their growth is likely to be even lower than we were expecting, unless they can really get those buybacks back up to 5 to 6% a year, which they were coming out of the COVID period. So at the price we see Berkshire Hathaway now, we're reducing our holding. But we'd be very happy to add back to our holding at lower prices. It's just a simple calculation of if they're going to grow at 6 or 7% a year without buybacks, we're less excited. If they can buy back at approximately 5% a year, we think they can grow in the mid-teens. So it's with the amount of cash they have on the balance sheet, this is a buyback story, but they've stopped buying back stock. So unless we start to see those buybacks kick in, we're not going to add to our positions. Thank you very much. Thank you very much for being clients, and we're very proud to be and grateful to be to managing your wealth, and we're very comfortable that, as you've seen from these top 10 stocks, we've got a wonderful portfolio, and we really think that portfolio is going to continue doing well for decades to come. Thank you.